Welcome to today's in-depth analysis to popular REIT ETFs available on the Singapore market. The Lion-Phillip S-REIT ETF CLR and the NikkoAM-STC Asia REIT ETF CFA. As investors increasingly turn to real estate investment trusts for income generation and portfolio diversification, understanding the nuances between these two leading options becomes crucial for making informed investment decisions. Both ETFs offer exposure to the lucrative REIT sector, but they follow distinctly different approaches that can significantly impact your investment outcomes. Today, we'll explore their structures, holdings, performance metrics, and suitability for different investor profiles to help you determine which might be the better fit for your financial goals. The REIT landscape in Asia. Before diving into the specifics of each ETF, let's take a moment to understand the broader context of REITs in Asia. Real estate investment trusts have become increasingly popular investment vehicles across Asian markets, offering investors a way to access real estate returns without the complications of direct property ownership. Singapore established its REIT market in 2002 and has since grown to become one of Asia's largest and most developed REIT hubs, known for its strong regulatory framework and attractive yields. Meanwhile, other Asian markets like Hong Kong, Malaysia, and Thailand have developed their own REIT sectors, each with unique characteristics and property focuses. This regional diversity creates both opportunities and complexities for investors looking to access the Asian REIT market, which is precisely where specialized ETFs like CLR and CFA come into play. Fund Origins and Management. CLR Lion-Phillip S-REIT ETF. The Lion-Phillip S-REIT ETF was established in October 2017 as a collaborative effort between Lion Global Investors and Phillip Capital Management. Lion Global Investors brings extensive experience in Singapore's investment landscape, while Phillip Capital contributes its distribution network and retail investor reach. The fund's strategy centers on tracking the Morningstar Singapore REIT Yield Focus Index, which employs a methodology that screens for high-yielding S-REITs with strong financial health indicators, including dividend sustainability metrics and balance sheet strength. CFA NikkoAM-STC Asia REIT ETF launched in May 2017. The NikkoAM-STC Asia REIT ETF is managed by Nikko Asset Management in partnership with S-REITs Trading Company. NikkoAM brings its substantial regional expertise in Asian markets, while S-REITs Trading contributes deep understanding of property markets across Asia. CFA tracks the FTSE EPRA REIT Asia ex-Japan REIT 10% capped index, which includes REITs from multiple Asian countries. The index employs a capping methodology to ensure that no single constituent dominates the portfolio, promoting diversification across both countries and individual REITs. Geographic exposure. A fundamental difference. The most significant distinction between these two ETFs lies in their geographic focus. CLR's Singapore-centric approach. CLR provides investors with pure exposure to Singapore's REIT market. This concentrated approach means all underlying REITs are listed on the Singapore Exchange. All distributions are in Singapore dollars, eliminating direct currency risk. Properties may be located in Singapore or internationally, but the REITs themselves operate under Singapore's regulatory framework. Investors gain exposure to approximately 20 to 25 Singapore REITs, representing the majority of the country's REIT market. Singapore's REIT sector is known for its stringent regulatory environment, requirement for REITs to distribute at least 90% of taxable income, strong corporate governance standards, relatively stable political and economic environment, global property portfolios, despite local listings. CFA's Pan-Asian diversity. In contrast, CFA casts a wider net across the Asian REIT landscape, includes REITs from Singapore, Hong Kong, Malaysia, Thailand, and potentially other developing REIT markets in Asia. Offers exposure to approximately 30 to 40 REITs across multiple countries, provides access to different property cycles, economic conditions, and currency movements. Singapore typically represents the largest country allocation, approximately 60 to 70% of the portfolio. Hong Kong REITs usually form the second largest allocation, approximately 20 to 25%. The remainder is distributed across other Asian markets. This multi-country approach exposes investors to different regulatory frameworks governing REITs. Various distribution requirements across countries, multiple currency influences, diverse property market cycles, broader range of property types and specializations, portfolio composition and holding. CLR's portfolio breakdown. CLR's portfolio consists exclusively of Singapore-listed REITs, but these REITs own properties across various sectors and geographies. Sector allocation approximate: retail REITs, 25 to 30%; industrial REITs, 20 to 25%; office REITs, 15 to 20%; hospitality REITs, 10 to 15%; healthcare REITs, 5 to 10%; diversified REITs, 10 to 15%. Top holdings typically include Capital and Integrated Commercial Trust, Mapletree Pan Asia Commercial Trust, Ascendas REIT, Mapletree Industrial Trust, Keppel DC REIT, Frasers Logistics and Commercial Trust, Mapletree Logistics Trust, Suntec REIT, Frasers Centrepoint Trust, Keppel REIT. Many of these Singapore-listed REITs actually own properties across Asia, Europe, Australia, and the United States, providing international diversification despite being listed solely in Singapore. CFA's portfolio breakdown. CFA's more geographically diverse approach results in a different portfolio composition. Country allocation approximate: Singapore, 60 to 70%; Hong Kong, 20 to 25%; Malaysia, 5 to 7%; Thailand, 3 to 5%; other Asian markets, 0 to 5%. Sector allocation approximate: retail REITs, 20 to 25%; industrial REITs, 15 to 20%; office REITs, 25 to 30%; hospitality REITs, 10 to 15%; healthcare REITs, 3 to 5%; diversified REITs, 10 to 15%. Notable non-Singapore holdings may include Link REIT Hong Kong, Champion REIT Hong Kong, Fortune REIT Hong Kong, Sunlight REIT Hong Kong, IGB REIT Malaysia, KLCCP Stapled Group Malaysia, CPN Retail Growth Thailand, QUP Premium Growth Thailand. The inclusion of these non-Singapore REITs provides exposure to different property markets and economic conditions, particularly the large Hong Kong commercial real estate sector and emerging REIT markets in Southeast Asia. Fund metrics and financial characteristics. Looking at the financial metrics of both ETFs reveals important difference: expense ratios and fee structures. CLR, total expense ratio, approximately 0.60% per annum. Management fee, 0.50% per annum. Trustee fee, 0.02% per annum. Other fees and expenses, approximately 0.08% per annum. CFA, total expense ratio, approximately 0.60% per annum. Management fee, 0.50% per annum. Trustee fee, 0.03% per annum. Other fees and expenses, approximately 0.07% per annum. The expense ratios are nearly identical, removing cost as a major differentiating factor between the two ETFs. Distribution policies. CLR, distribution frequency, semi-annual, typically January and July. Distribution policy, distributes 100% of dividends received from underlying REITs. Historical yield, approximately 4 to 6% annually. CFA: distribution frequency: quarterly, typically March, June, September, December. Distribution policy, distributes 100% of dividends received from underlying REITs. Historical yield, approximately 4 to 5.5% annually. CFA's quarterly distribution schedule may appeal to investors seeking more frequent income payments, while CLR's semi-annual approach results in larger, but less frequent distributions. Liquidity and trading characteristics. CLR, average daily trading volume, moderate. Bid-ask spread, typically narrow, but can widen during market stress. Assets under management, moderate size within Singapore ETF landscape. CFA, average daily trading volume, higher than CLR. Bid-ask spread, generally tighter than CLR. Assets under management, larger than CLR. CFA's higher liquidity can be advantageous for investors who may need to buy or sell larger positions, potentially resulting in better execution and lower trading costs. Performance analysis, yield, total return, and risk-dividend yield comparison. Both ETFs focus on delivering attractive yields to investors. CLR's yield profile, Historical yield range 4 to 6% annually. Yield focus explicit in index methodology. Semi-annual distributions create larger but less frequent income payments. Yield stability benefits from Singapore's consistent REIT regulations. Potential for special distributions during exceptional periods. CFA's yield profile. Historical yield range 4 to 5.5% annually. Yield varies more due to multi-country exposure. Quarterly distributions provide more regular income stream. Yield influenced by multiple regulatory environments. Geographic diversification can sometimes smooth yield fluctuations. Total return performance. Looking beyond just yield to total return reveals interesting patterns. CLR's total return dynamics. Strong performance during periods of Singapore REIT outperformance. More direct exposure to Singapore monetary policy and interest rate movements, sometimes higher volatility due to single country concentration. Better performance during periods of SGD strength. More sensitive to Singapore-specific economic factors. Tourism trends, office demand, retail spending. CFA's total return dynamics. More balanced performance across different market environments. Partial insulation from country-specific downturns. Exposure to multiple currency effects, both positive and negative. Ability to capture outperformance in non-Singapore Asian REIT markets. Less sensitive to Singapore-specific factors. Risk characteristics. The risk profiles of the two ETFs differ significantly. CLR's risk profile. Lower currency risk. Purely SGD-denominated. Higher single country concentration risk. Greater sensitivity to Singapore monetary policy. More homogeneous regulatory risk. Potentially higher sector concentration within Singapore's REIT market. CFA's risk profile. Higher currency risk across multiple Asian currencies. Lower country concentration risk. Exposure to multiple monetary policy regimes. Diverse regulatory risks across different jurisdictions. Broader sector exposure across different property types. Core satellite strategy. Use CFA as the core Asian REIT holding for diversification. Add individual Singapore REITs, or CLR, as satellite positions to overweight specific opportunities. Geographic building blocks. Use CLR for Singapore exposure. Complement with other region-specific REIT ETFs or individual REITs for global coverage. Dynamic allocation. Adjust allocations between CLR and CFA based on relative valuations, yield opportunities, or macroeconomic outlook. Recent developments and future outlook. Singapore REIT market developments. Several factors are shaping Singapore's REIT landscape. Continued consolidation among S-REITs, creating larger and more diversified entities. Increasing focus on ESG, environmental, social, governance factors in property management. Digital transformation and technology adoption in property operations. Evolution of retail spaces in response to e-commerce growth. Adaptation of office properties to hybrid work models. Growth in specialized REIT segments like data centers and logistics. Broader Asian REIT market trends. The wider Asian REIT market is experiencing its own evolution. Development of REIT frameworks in emerging Asian economies. Growth of specialized REITs in markets like Hong Kong and Japan. Increasing cross-border property acquisitions by Asian REITs. Greater institutional investor participation in Asian REIT markets. Growing significance of sustainability and green building certifications. Evolution of hospitality assets. Post-pandemic regulatory developments. Regulatory changes continue to shape the REIT landscape. Singapore. Ongoing refinements to the REIT regulatory framework. Review of leverage limits and distribution requirements. Enhanced disclosure requirements for better transparency. Other Asian markets. Continued development of REIT regulations. Emerging markets. Harmonization efforts for cross-border REIT investments. Tax treaty considerations affecting REIT distributions. Conclusion. Making your choice. The decision between CLR and CFA ultimately depends on your investment objectives, risk tolerance, and view of Asian property markets. Choose CLR if you want pure Singapore REIT exposure with minimal currency risk. Prefer the established regulatory environment of Singapore's REIT market. Have high conviction in Singapore's property market outlook. Value yield stability and Singapore's proven REIT track record. Already have international diversity elsewhere in your portfolio. Prefer semi-annual distributions for tax planning purposes. Choose CFA if you want broader Asian real estate exposure beyond just Singapore. Are comfortable with some currency risk for greater geographic diversification. Believe in the growth potential of emerging Asian REIT markets. Prefer quarterly income distributions for more regular cash flow. Want exposure to different property cycles across multiple economies. Seek a more regionally diversified approach to Asian real estate. Both ETFs offer valuable exposure to Asian real estate through liquid, dividend-focused investment vehicles. Whether you choose the focused approach of CLR or the diversified strategy of CFA, both can play important roles in income-oriented investment portfolios. For many investors, the ideal approach may involve holding both ETFs in proportions aligned with their specific investment goals, geographic outlook, and income requirements. By understanding the unique characteristics of each fund, you can make a more informed decision that supports your long-term financial objectives.